The biggest risk is that the stock falls below the strike and I don't get assigned. And that's the game. Risking not selling the stock and getting paid time premium for that risk. Going out farther in time means there's more time for the stock to move, which is why I always start out looking at the short-term ones and hopefully just find a decent trade there and don't have to look at too many other trades. If I have to go farther out in time because the stock can move more over a longer period of time, I look to sell a lower strike price.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 59. We're in the money. But before we jump in today, let's talk about how you can make many, many friends today. You know the best way to make a friend? It's to share something with them that can make them wealthier. It's true. Studies prove it. So the best thing you can do today is to tell someone about the Wealth Building with Options podcast. That, and of course, become a paid subscriber. With your paid subscription, you'll get video extra podcast episodes so you can get hands-on video training on things we talk about on the show, subscriber-only posts where I'll drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades such as credit spreads and much more. And the best part is your paid subscription helps keep this show on the air. To become a paid subscriber, just go to the Wealth Building with Options Substack page and sign up. The shortcut to that page is wealthbuildingpodcast.com. That's wealthbuildingpodcast.com, and choose a monthly or annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching, our Smart Income video class, which alone is valued at more than the subscription, and get on the wait list to get a signed copy of my new book, Build Consistent Wealth with Options, scheduled for release on April 28th of 2026. Several years ago, we had one of those banking regulation tightenings that seem to come around every now and then in the perpetual cycle of relaxing regulation, leading to a financial crisis, leading to tightening regulation, and rinse, wash, repeat. A neighbor of mine was a big trader at one of the major banks, super smart guy, just prior to one of these times. And well, he ended up being one of the casualties when the banks needed to get rid of some people, whether they did something wrong or not, which of course is done for PR purposes. And because the tighter regulations mean they can't make as much money trading and need to cut overhead. But anyway, I was chatting with him several months after he left the bank and asked what he's up to. He said, throwing the ball around with the kids, stuff like that, and managing my family's stock portfolio. And so I know enough about trading and investing to know that when you're talking to someone who really knows what they're doing, keep listening and keep asking questions. So I asked him, so what have you been doing in your investing? He said, well, I write a lot of covered calls. So we started talking shop and I asked how he does it. And he said, I usually sell in the money calls. And I was like, wait a minute. This is a trader that I know to be crazy smart. And he's selling in the money covered calls? What the WTF? And he said, yeah, when I have a stock that I don't like anymore, or it's risen so much that it's become overvalued, I sell an in the money covered call on it and just look to get assigned and sell the stock, and I get a better price. And that made me think differently about, well, about everything related to the wheel. So let's take a look at in the money covered calls and cash secured puts. I have since decided to kind of follow in my friend's footsteps. Now, in the money covered calls aren't something that I do on most trades, but I do them sometimes for a couple of reasons. And the main one is the same thing. It's just more likely to get assigned and sell a stock that I no longer want to own. Oh, yeah, plus getting the premium. And the rationale for stocks that fall into that category, they can kind of range from being overpriced based on fundamentals. Maybe I found an opportunity for a greater dividend yield or something. Technically expecting a pullback on a stock that I'm not committed to based on fundamentals, or maybe the stock itself is nothing special, but it's been a strong wheel play in the past because of how the options were priced, and maybe now that changed. On the one hand, the concept of selling an in the money covered call, it's pretty straightforward, but there are some nuances that require attention. How you think about intrinsic value and time value really makes or breaks this trade. Let's say I own 100 shares of a $220.50 stock that rose quite a bit in value, and I earned a nice profit over time. Now, let's say I believe the stock has become overpriced relative to where I believe it's valued. So I'll plan to write an in the money covered call. And one of the things that means is that it has a delta over 50, which means it's more likely than not that the stock will be called away, that I will get assigned on that call, because we think about delta as the likelihood of an option expiring in the money and leading to assignment. That's a loose rule of thumb anyway. But which call should I trade? It's usually my preference to sell a short-term call for this purpose. Just knock that sucker out. So I might look at maybe a call that has 4 days until expiration. Again, I said that the stock was trading at $220.50 in this example. So I'd like to use a call that's in the money, but still close enough to have a fat enough premium. So maybe I'll look at the 4-day to expiration 217.5 calls. Those are in the money by $3. And let's assume that it's the morning, so there's not really a lot of volume to give me an idea of how much liquidity there is, but there's a fair enough amount of open interest. And turns out that this example, it's pretty liquid, actively traded. So I should be able to middle it at least somewhat. If I sell these 4-day to expiration 217.5 calls at, say, $4.75, remember, they're in the money by $3. So that's $3 worth of intrinsic value. So 475 minus 3 means I'm selling it $1.75 over parity. So $1.75 of time value. Breaking out the value components this way into time value and in the money value, this offers very important clarity when it comes to in the money options. If I were to get assigned, I would sell this stock effectively at $222.25, which is $1.75 above where the stock is now. The time value is $1.75. The time value is the extra amount that I get if I'm assigned and sell the stock that changes my cost basis. Or in this case, the amount that I effectively sell it for as opposed to buy it for. Because think about it this way. If the stock was at $220.50 and I get assigned and have to sell it at $217.50, I lose $3, right? Because I'm selling at $3 lower upon assignment, but I have $4.75 in total option premium. So net, I make $1.75 extra. The $3 of intrinsic value makes up for what I negative scalp on the stock. Think about the intrinsic value as if it were a direct 100 delta hedge. Okay. This is kind of a novel way to think about it. I don't hear people who trade covered calls thinking about it this way, but it's kind of a good way to think about it. And it kind of relates to synthetics. Think about the intrinsic value component as if that were a direct 100 delta hedge. And then the time value is the benefit of using the call to try and sell the stock. The stock can fall almost $3 if it's at $217.51 or more at expiration. I'd be poised for automatic assignment. If assigned, I sell $1.75 better than I could in the equity market. But if the stock falls more than $3, so falls to a point below the strike price, and I don't get assigned, well, I still keep the entire option premium. So my break even is the stock price at the time the trade is made minus the whole option premium. So $220.50 minus $4.75. So $215.75 becomes my new break even. And that's that direct hedge from the intrinsic value plus the time premium. Kind of an interesting way to think about it, isn't it? Now imagine instead I sell maybe the 200 strike calls at $20.70. Okay, so that's way in the money. That's $20.50 of intrinsic value, and then just 20 cents of time value. So it's kind of a give and take here. As for the in the money value, the intrinsic value, I'm protected much more. If I think about this as a direct 100 delta hedge, I'm protected a lot more because I'm significantly more likely to get assigned because it's so deep in the money. And maybe that's my objective. I mean, because I'm doing an in the money call, it is my objective. The stock can fall a whole $20.50, and I'd still sell it better than where the market is now by the amount of the time value, 20 cents. But, it's only 20 cents. It's not really a whole lot of benefit to using the call to sell the stock in this case. In fact, because I'm only getting an extra 20 cents, in a way, you could think about it as you're actually adding risk, right? You're adding the risk that you don't get assigned on a stock that you want to get assigned. And you're only getting 20 cents from it. Now, here's a pro tip for you. You can kind of cheat a little and get the gist of how much time value in the money call might have if you look at the corresponding put value. Remember this from our discussions of put call parity and synthetics and such? Or if you read up on those things, which you should. I mean, sure, you can always do the math and figure out what the intrinsic value is and consequently what the time value is. But if you just want to sort of eyeball it, just look at what the corresponding put value is, especially if it's a really short-term option. They're going to be pretty darn close, unless it's hard to value or there's a dividend X date coming up. Now, when I do this, actually, when I trade any covered call or cash secured put, I always look around at several different choices. The biggest risk is that the stock falls below the strike and I don't get assigned. And that's the game. Risking not selling the stock and getting paid time premium for that risk. Going out farther in time means there's more time for the stock to move, which is why I always start out looking at the short-term ones and hopefully just find a decent trade there and don't have to look at too many other trades. If I have to go farther out in time because the stock can move more over a longer period of time, I look to sell a lower strike price. Maybe now I'll look at an 11-day to expiration option. So instead of the 217 and a half calls that were $3 in the money, maybe I'll look at the 215 calls. Let's say I can get $8.10 when I sell those, if I middle a little bit. The time premium on these is $2.60, right? It's $8.10 of total premium minus where the stock is now, minus the strike price to get the intrinsic value, right? So 810 minus the intrinsic value is $2.60. Is it worth risking the stock falling $5.50, which is below the call strike, over the next 11 days and not selling the stock to be able to sell it $2.60 better than where the stock is right now? It doesn't have a super great advantage over the first example that we talked about, the 4-day to expiration 217 and a half calls. And usually if I just go out even another week and maybe a lower strike, or even another week and a still lower strike, I don't know, a lot of times you don't really get any great advantage. Too much uncertainty for a little extra premium. So if I'm using an in the money call, it's usually because I really want to sell the stock, obviously. So I'm always weighing urgency against potential strategic opportunity. I might consider a much longer dated option. And when I do that, it can kind of get a little interesting. I'd want to sell a lower strike to allow for more room for the stock to move. Let's say I go out a few months and I do sell the 200 strike calls, which in this hypothetical example, they're about 10% in the money, right? Specifically, they're in the money by $20.50, but they have $9.15 worth of time value. If I sell them at $29.65 and they're in the money by $20.50, that's $29.65 minus $20.50, that's $9.15 in time value. Is the 9 or 10%, again, think about it as 100 delta hedge, enough room to be fairly confident that I am going to get assigned? Or do I need to go even lower? Or do I not need to go that low of a strike? I mean, I'm kind of assuming a longer period of time to expiration, maybe like 4 months or something like that, or 3 months or whatever. I don't know, like maybe 3 or 4 months or something. The break even comes more into play with this scenario. So if I just think about it as the break even on the stock, that would be $220.50 minus the full option premium. So intrinsic and time value. So 220 and a half minus $29.65. The benefit again is the time value, $9.15 before the risk is too much because it falls below the strike and I don't get assigned. So let's actually do that math, right? $220.50 minus $29.65. Even if I don't get assigned, as long as the stock is above $190.85, I can sell the stock and still be better off than if I just held on to it right off the bat at $220.50 and not sold the call. This concept is technically accurate in shorter term examples too, but the time value is so much smaller in the shorter term examples that I frame it a little differently. But here, with a whole $9.15 of time value, that sweet spot that I talk about sometimes, which is between the effective break-even price and the indifference point, I mean, that's a pretty big swath of room that the stock can be in, and the call is a benefit to you. So what if I split the difference? Okay, stock is at $220.50. What if I sold these like 4-month options or whatever, the 215 strike calls? So just in the money by like $5.50. Let's say I can sell those at $19.90. Well, there's less intrinsic value, right? So that means there's less direct protection to the downside, only $5.50, but there's more time premium, right? Again, we're assuming I sold the calls at $19.90 in this example. So that time premium ends up being $14.40. And so that turns out to be an extra $5.25 as long as the call is assigned. That's how much you sort of outperform if you get assigned and sell the stock. So I would choose a long-term, closer to the money trade like this if I have a lot more confidence that the stock is not going to fall below its break-even price. And I'm focusing more on getting that extra $5.25 to sell at a higher price. So I don't know, basically you probably use longer term options like this less frequently. They do have value sometimes, but they're less frequent for sure than the shorter term ones. So basically there's not a universally right answer per se. Just look at several different strikes, several different expirations, and just rationalize through what the right answer is for that specific situation. And typically, you'll make the best decision that way. Now let's shift gears for a minute and talk about in the money cash secured puts. Well, you might expect that in the money cash secured puts have a lot in common with their covered call cousins. But with the put, we want to maximize our chances of getting assignment to buy a stock if we're doing it in the money, right? Like with the calls, the in the money put needs to be thought of a little differently from the more common at and out of the money versions. One difference is that the skate yield becomes somewhat less meaningful when it comes to the in the money cash secured put. Our focus is going to shift to getting assigned. And the yield is, well, still to some degree relevant. Maybe we'll talk more about that later. Another difference to keep in mind is the intrinsic value's relationship to the trade. With in the money covered calls, the intrinsic value can be thought of as a direct penny for penny hedge on the stock. With in the money cash secured puts, it's kind of more like just more aggressive that I want to buy the stock. Think of it like the intrinsic value racks up profit penny for penny as the stock rises. Think of it that way. And then the time value is the discount below the current stock price that the investor would effectively own the stock if they get assigned. The idea with selling in the money puts is that, well, first of all, you really want to get assigned. Second of all, you want to start participating in upside now. If the stock goes up a little bit, I want to make some money on it. But thirdly, you want to get the stock at a cheaper price than you can do so by just buying it outright in the market right now. Let's say you're looking at a stock that's trading at $89.25. It has nice fundamentals. It is below value, like it below its intrinsic value by a reasonable margin of error. It's bouncing off support and beginning to head higher. So you think, okay, let's look at the 10-day to expiration 92 strike puts that I can sell at $3.65. How much over parity is that? Well, $92 for the put strike minus $89.25 is $2.75. And if I'm assuming that I sell the put at $3.65, so that's 90 cents of time value. What is the goal in this case? All right. Again, it's to try and buy the stock effectively 90 cents lower than where it's trading right now, which in this case, what did I say? The stock is trading at $89.25. So effectively, I'm doing this so that I can buy the stock at $88.35. As long as the stock is anywhere below $92 at expiration, that is what will happen. I will effectively buy it at $88.35. Not getting assigned and not buying the stock is the risk in the case of in the money cash secured puts. The indifference point is the stock price plus the total premium, intrinsic value as well as time value. And so that is going to be $92.90. Another way to look at it is it's the time value plus the strike price. The math ends up working out the same. And still another way to think about it, and maybe this one is the best and most straightforward way, is to look at it like this. Your maximum profit is the $3.65 total premium collected. If the stock rises more than $3.65 from where it was when you sold the put, you'd have been better off buying the stock. So if between now and expiration, I said this is a 10-day trade in this example, if the stock is not up by more than, well, what does that come out to? 365 divided by 89.25 is about 4%, right? If the stock is not up by more than 4%, selling this put will have been advantageous, more advantageous than just buying the stock in the market. And that is true even if the stock falls a whole bunch and I'm getting assigned at a crappy price, because I still would do better than if I just bought the stock. I still do 90 cents better by the amount of the time value. And the plan was to buy the stock anyway. So yeah, it holds true. Even if it's a losing trade, you lose less. Now, I was talking about skate yield before, right? Which is just simply the option premium, the whole option premium divided by the strike price. In some ways, it's a little bit less meaningful for the reason we're kind of talking about. This whole plan has two potential ways into it. I can just buy the stock, or I can sell the in the money cash secured put. If the stock rises above the strike price and the put is not assigned, hey, it's a nice 4% win in 10 days. Annualize that, and it's like almost 150% or something. Looks impressive. But it might not be a whole bunch better, or it might even be less than what I could have made by just buying the stock, right? We don't know how it's going to play out. And hey, if I'm considering my wheel trading to be an augmentation to make my long-term buy and hold strategies better, especially if I'm basing it off fundamental analysis and the stock's intrinsic value, well, if this was a stock that does end up popping 10% and I only make 4% because I sold the put, I kind of failed myself a little bit, because the long-term buy and hold is about the long game. And so that's what you miss out on. These trades do happen sometimes. They've certainly happened to me where I've sold a put because I wanted to get assigned and the stock really took off and I made a smidgen and missed out on a lot. And those are going to happen sometimes. And that's why they say the wheel strategy smooths out your returns. It lowers your volatility. You don't make as much when the market is higher, and you don't lose as much when the market is lower. And that about wraps it up for this show. But before you go, please make sure you're subscribed on your favorite podcast platform, whether it's Spotify, Apple Podcasts, whatever it may be. And if you would be so kind as to leave a comment, I would surely appreciate it. Let me know what you like or what you'd like to hear more of. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.